afternoon. Welcome to the full year 2024 earnings results briefing for Union Bank. My name is Jackie De Jesus and I will be your moderator for today's call. Before we begin, some reminders. We have put microphones on mute to minimize background noise during our presentation. Number two, questions have been requested from the audience in advance, which we will go through during the Q&A portion. In case there are more questions from the floor, please feel free to click on the raise hand button and submit your questions via the Q&A box. Those not taken up during the Q&A session will be answered via email. Lastly, this briefing will be recorded. By joining the session, you are consenting to your name, voice, image, and chat comments being recorded for use and dissemination. For today's call, Dominic Panal, our trading head for global markets, will kick us off with Union Bank's macroeconomic and industry outlook. After, Union Bank's CFO, Demi Lozano, will present the bank's financial performance. With that, let me turn you over to Dominic.
Let's go to the first slide, please. So since the U.S. election and the Republican sweep, we have seen a significant repricing of U.S. interest rate probabilities and the U.S. Treasury yield curve. However, in recent weeks, the focus has shifted to the slowing down of the economy from tariffs and government spending cuts. Atlanta Fed's GDP now is currently at negative 2.4% for the first quarter, while US President Trump recently said that the economy faces a period of transition, and US Treasury Secretary Scott Bessent said that the US needs a detox from public spending. Next slide, please. So where does that leave the rest of the year interest rate outlook? Latest Fed funds futures implied probabilities for 3 cuts for the year, with the earliest coming in June. At one point earlier in the year, the implied number of cuts was as low as 1. We do think that in the short term, that 1 to 3 cuts for the year would be the short-term trading range. One move away from the latest Fed dots of around 2 cuts for the year. Unless there are further developments on the tariff front or if there is further deterioration in the outlook for the US economy. This is a far cry from as much as 7 cuts priced in to the curve during the third quarter of 2024, when the election was still up in the air. Next slide, please. So far, one more slide, please. For now, the so-called Trump trade has been clawed back to varying degrees. U.S. equities are trading at pre-election levels, while U.S. Treasuries are at post-election lows currently. Next slide, please. So in the last year, the Fed delivered 4 rate cuts. That has changed the shape of the curve significantly. Right now, we have a somewhat positive sloping curve, and with the widening of emerging market Asia credit to start the year, we do see some value in ROP dollar bonds, with the 10-year ROPs offering a 100 basis point yield pickup against the Fed funds rate and around 120 basis points against 1-year US Treasuries. Next, please. So onto the local front. One slide forward, please. So onto the local front, BSP bucked market expectations in its last meeting, opting to hold the policy rate at 5.75%, despite market broadly pricing in a cut in the run-up to the meeting. We do expect that the April 10 meeting will be a live one, and given recent developments in the Philippine inflation rate and with growth concerns abroad, we are assigning a better than even odds of a cut in that meeting. Next slide, please. So the GS curve has sold off slightly to start the year, up around 10 to 15 basis points. This also means that the curve is now steeper and more positively sloped. With odds still favoring a rate cut, we do see value in the belly and long end of the curve at these yields. Next slide, please. So in terms of relative value, the GS curve outperformed US Treasuries in the fourth quarter, but has slowly given back its outperformance to start the year. This happened despite similar changes to policy rate expectations in this time period. Next slide. The driver for this has been BTR's auction schedule and the triple R cut in October 2024. Fourth quarter issuance schedule from the BTR was less than half of the third quarter offering, due to strong auction demand earlier part of 2024. With the calendar turning, BTR now shifts back to its regular pace, with first quarter auction sizes at roughly 200 billion pesos per month. Next slide, please. So headline CPI is now at 2.1%, at the bottom end of BSP's 2 to 4% target range. The BSP has stated that the CPI risk, however, are to the upside going forward. Next slide. So while we expect that we might see lower inflation in the coming months, the food base effects will start to turn in the second half of the year. The lowering of rice tariffs, as you may remember, started in July 2024. With electricity prices also scheduled to slowly increase, we do see that inflation will slowly move away from the bottom end of BSP's target range. And the BSP themselves have said that they expect 2025 inflation to average 3.5%. And the last slide, please. So for a dollar peso, it's currently trading at 57.25, slightly lower for the year amidst the backdrop of broad dollar weakness. We do not expect further depreciation of the peso above the 59 level in the current outlook, and they're expecting it to trade within a range of 55 to 59 pesos in the short term, with the break either side to be determined by large global developments. That's it. Thank you.
Thank you, Dominic. Demi, for the financial performance, please.
Thank
Thank
you.
you.
Yeah, one
One
second. Take this up.
Yes, that's better. Yeah, I just wanted to start off with a quick snapshot of some of the key metrics that we're following. And what you can see here is that we continue to gain traction in growing our retail business and the recurring revenues. Our customer base has increased by more than 3 million year on year, bringing the total to more than 17 million customers. Similarly, our net revenues have demonstrated consistent improvement year on year, supported by our above average net interest margin, which is also up by 49 basis points versus last year, driven by our shift towards more consumer loans. Additionally, our ability to generate fees from our expanding client base has also contributed to this growth, resulting in net revenue to asset ratio of 6.8%. The majority of our revenues come from recurring income, while our trading income continues to improve as macroeconomic backdrop becomes more favorable. UnionBank delivered net income of 12 billion for the fiscal year 2024, 31% increase from the 9.2 billion recorded previous year. The parent bank continues to be the main driver of net income, delivering a net income of 12.9 billion, up by 115% versus last year. This is partially offset by losses in Union Digital. However, on a positive note, we see continuous improvement in Union Digital. They have addressed the credit and operational challenges faced in the early part of the year, and now Union Digital is focusing on higher quality, low risk segments via short tenor, low ticket size loans. And the results have been positive so far. Our ROE shows continuous improvement throughout the year, ending at 6.4%. Netting out the TSA and other one-off credit provisions, our ROE would have been better than 7%. This is a promising trend, and we expect to sustain this in 2025. Our net interest income continues to reach record highs on the back of widening net interest margins, which ended at 6% in fiscal year 2024. As mentioned earlier, our NIM is exhibiting an upward trend due to the bank's steady shift towards more consumer loan. We expect this to be beneficial for the bank moving forward, especially as interest rate environment becomes more favorable. Our earning asset base was steady year on year, only growing 3% in 2024. This is our deliberate strategy as we intended to balance our portfolio better by shifting from institutional loans towards our consumer base. Our gross loans are relatively flat, as I mentioned, year on year. as we deliberately manage the growth of institutional banking business and allocated most of our capital to the higher yielding consumer business. Our consumer portfolio grew by 8% year-on-year, and this is mainly driven by the growth in our credit cards, which are up by 13% year-on-year, as well as CSB, which is up by 9% year-on-year. As a result, our loan mix in terms of consumer loans to total loans is now 61%, or close to 3 times the industry average. The bank's low-cost deposits are also growing in line with the industry at 4% year-on-year. Our total deposits have declined year-on-year, and this is due to the decline in high-cost deposits, but also because we have shifted some of our funding from high-cost deposits towards alternative sources such as interbank borrowings, repos, and currency swaps. The group's strategic decision to fund its assets through alternative sources has reduced our dependence on high-cost deposits, allowing us to better compete in terms of rates offered to our clients. Our net interest income increased by 14% year-on-year, our non-interest income increased by 14% year-on-year, driven by the parent bank. Continued growth in our customer base should support steady growth in fee income for years to come. We also saw better trading income versus last year. This slightly helped deliver the strong year-on-year growth in non-interest income for the bank. We were able to manage operating expenses within the year, even with the strong growth in our top line. OPEX declined by 1% year-on-year from 44.9 billion to 44.3 billion. Notably, our one-off expenses related to the integration of the Citi consumer business have decreased by 73%. Recall that in the first quarter analyst briefing, we mentioned that we successfully completed the integration in March of 2024, at the end of March, and as a result, we have been saving approximately 300 million per month since April. The increase in core OPEX is due to our continued investment in customer acquisition, service delivery, and client engagement that will support future earnings. Overall, our cost-to-income ratio improved to 56% versus 63% in 2023. If we normalize for one-off expenses, cost-to-income would have been as low as 54%. We remain optimistic that in the coming years, we can achieve and surpass the 50% mark that we set as a target for ourselves. As mentioned in previous analyst briefings, the increase in credit cost is attributable to Union Digital. This resulted in an annualized credit cost increase of 104 basis points in 2024. We also have mentioned that we do not expect this elevated cost to persist throughout this year, as we have already recognized most of the required cost reserves in the first half of last year. Overall, the credit and operational issues in UD have been contained. For the parent bank and other subsidiaries, our credit costs slightly increased, but we've anticipated this growth in credit costs as we've shifted our focus to consumer space, particularly the credit card business. Additionally, we reported in our first quarter 2024 analyst briefing that we had to book one-time charge for a legacy account in the first quarter of the year. Moving on to the NPLs, our NPL ratio is trending upwards as our portfolio mix shifts to the consumer loans that have higher NPL. However, if you look at the NPL ratio for consumer loans, it is actually showing an improved trend from 8.6% the first quarter of last year to 8.1% in the fourth quarter, or towards the end of last year. Moreover, if we isolate the parent bank, its NPL ratio is on par with the industry, and our coverage ratio is higher than industry average. In fact, our credit cards, personal loan businesses are fully provisioned with coverage ratio above 100%. Our capital ratios for fiscal year 2024 have improved significantly versus the prior periods. This is brought about by the 10 billion SRO, which we concluded last May. We now have sufficient capital to fund future growth. In addition to the company's financial performance, we'd like to provide you with an update on some of our key operational initiatives and milestones aimed at enhancing the services and products we deliver, as well as improving the current overall customer experience. On the Citibank integration, the target customer acquisition strategies, impactful digital marketing, and competitive promotional offers resulted to increase in new card acquisitions from 5,000 per month pre-pandemic to nearly 50,000 per month. Our portfolio grew from 10 billion pre-pandemic to 128 billion at the end of the year due to innovation in lending programs and a more robust risk framework. Wealth and private banking also experienced strong growth, with assets under management increasing tenfold from 22 billion pre-pandemic to 244 billion. This growth was driven by enhanced wealth advisory services, new investment products, and an expanding retail investor base. Looking at other partnerships, UBX's growth has been fueled by strategic partnerships, including a major investment by SBI Holdings from Japan, a global financial services leader. This partnership strengthens UBX's position in the fintech space, enabling it to develop innovative solutions and expand its regional footprint. UnionBank has taken a major step in enhancing its investment services also by agreeing to a merger with Atram, one of the largest independent trust companies in the Philippines. This strategic move is a testament to our commitment to providing best-in-class financial and investment solutions for our customers. Existing UnionBank and Citi cards underwent more than just a rebranding process. By enhancing features and broadening rewards, we have significantly improved the customer experience at all interaction points. Strategic financing collaborations with global technology giants such as Apple and Samsung provide cardholders with seamless and innovative purchasing options, further solidifying UnionBank's position as a leader in digital finance. Legacy partnerships with merchants such as Shell and Mercury Drug were not only preserved but also enriched with additional benefits and privileges. The inclusion of new partners like SNR has further diversified customer options, ensuring that each transaction offers increased value, flexibility, and convenience for our customers. So just a few things I want you guys to take away from this. UnionBank posted strong net income growth of 31% year-on-year, reaching 12 billion. And this was driven by robust top-line revenue and improving margins. We expect this to continue as our focus now, after the Citi integration, is to reap the value and synergy of the integrated customer operations, and thus the focus on cross-selling. An additional enhancement in our financial performance is evident through the reduction in our cost of operations. As the expenses associated with Citi integration have now concluded, looking ahead, any increases in operational expenses will stem from investments that promote revenue growth, specifically in areas such as customer acquisition, service delivery, and client engagement. This year, UBB faces increased credit costs attributed to the legacy operations of our subsidiaries, especially UT, situation which we have successfully addressed and managed by the end of last year. Looking ahead, we anticipate that credit costs will stabilize as we have adjusted our lending strategy in UD to concentrate on lower risk segments. Additionally, with our successful integration of the Citi consumer business, we are now positioned to enhance our cross-selling initiatives, which will contribute to further improvements in our cost-to-income ratio. And that's it. So Jackie, hand it over.
Thank you so much, Demi. So for our question and answer session for today, we will be joined by Demi Johnson Sia, UnionBank's Treasurer and Head of Global Markets, as well as Carlo Añenosa, UnionBank's Investor Relations Head. So we will start off with the questions we received in advance, but you may also click on the raise hand button or submit your questions via the Q&A box. So the first question is actually on Citi. Do you have any updates on the Citi consumer business integration?
I'll take that. We already exited the TSA at the end of the first quarter last year. So the direct costs were completed since then. However, there were still some integration costs, which were completed by the end of the year. Our costs are now directed to continued investment in customer acquisition, service delivery, and the client engagement, which will help fuel our cross-selling and growth in the cost in both credit cards as well as personal loans. After 2 years of integration, we are now seeing the fruits of our labor. As stated earlier, we have tremendously grown the customer base with the consumers as the backstop. Our credit cards showed promising results. Aside from growing 13% year-on-year, we're now adding an average of close to 50,000 new customers per month versus less than around 5,000 in 2019. Again, this is a result of our targeted customer acquisition strategies as well as strong digital marketing and the competitive promotional offers. The completion of the Citi consumer integration is just the beginning of this transformation, and we have our enhanced capabilities. We can now focus on our resources on further growth and continuing to delight the customer base of UnionBank.
Thank you
Yeah.
so much for that one. The next question is on loan growth. Why is your loan growth flattish in 2024 compared to the double-digit growth of the industry?
Yeah, so we actually made a deliberate strategy since the start of the year. What we will be doing is moving most of our capital to the consumer side. So there was a focus of growing it, which did grow by 8% on the consumer side. So essentially shifting from more of the institutional and moving it towards the consumer, which by now I believe the number is 61%. Right? I think that's so we ended the year already with over 60% of our loan portfolio on the consumer side. So it was really a deliberate approach. We felt that we need to move more on the consumer, and that will continue this year. Though we probably expect a little bit more loan growth across the board for 2025.
Thank you so much. On a related question, what is the growth outlook for the retail loan book? How about for the other segments like corporate and commercial segments, and how would the portfolio growth impact asset quality? So this is a question that was also raised by Rachel Cruz, a very similar question raised by Rachel Cruz on the chat box.
Great. So sorry. That was a couple of questions. What were they again, Jack? Just so I make sure I answered
Sorry,
it
the first one is what is the growth outlook for the retail loan book? And how about for the other segments like corporate and commercial segments?
Okay, well, we do expect to grow probably close to double digits for the consumer side. And trying to recall now, can you recall what it is for the
Yes.
corporate?
So the expectation for this year is that we will have double-digit growth in lending, but consumer will still grow faster than institutional loans, no? Institutional loans will grow less than 10%, but consumer will grow in the double digits.
Thank you for that. The related question is how would the portfolio growth impact asset quality for the bank?
We expect asset quality to trend downwards, and the reason is because we've already addressed the issues.
So you expect it to improve?
Yes, asset quality to improve. Sorry. When I say asset quality, I'm referring to NPL ratio.
That's great.
So asset quality should improve as NPL ratio is expected to trend downwards. And the main reason is because we've addressed most of the issues that are coming from Union Digital. And as presented by Dimi earlier, a portion of the NPLs as well as the credit cost that we have booked in 2024 came partly from Union Digital.
Yeah, so Union Digital will definitely improve. Since the middle of last year, we've been targeting a lower risk segment. So smaller loans, lower risk, lower tenor, shorter tenors. So we're already seeing the benefits of that change in focus. So definitely with UD, we expect lower credit costs. And I believe the same is true with the parent as well. We had some challenges with the integration that caused some temporary issues that helped spike the NPLs on the card side and personal loans. That has already been addressed. So So I think from both of those, we don't expect that to be recurring, at least at the same level. And so this year should show, we already start to see the benefits of those improvements.
Thank you for that. You mentioned Union Digital. Could we ask what is the outlook on Union Digital? Do we expect a turnaround this year?
So for Union Digital, we still expect to book some losses this year. And that's coming from the old bank or the legacy portfolio. Having said this, it will be significantly lower than what was realized last year. And the reason is because starting in the middle of last year, we already changed the credit parameters and we have focused on shorter tenor loans as well as better risk profile for the borrowers. And just to give you an update, the new portfolio is already generating positive net credit margin, and it's actually gonna be profitable in this year. The only reason why we still expect the losses is really because of the carryover coming from the old portfolio.
Thank you, Carlo. That was clear. There was a question on provisions as well. What is the reason for the elevated credit costs, and do we expect this to continue for 2025?
Well, I think that's basically been answered, right? So a big chunk of the provisions were UD, so quite a bit related to the loans that were given out in 2023 as well as the first half of 2024. So that will not be recurring because we decreased the size of the portfolio and again focused on again smaller ticket sizes, lower risk segments. We also had a big one-off for one of our corporates that we booked in the first quarter of last year. So hopefully that we don't have any other surprises on the institutional side. And again, on the credit card and personal loans, there were some credit costs related to the transition, but that has already been sorted out. So my answer is we believe it should be much better next year or this year, so in 2025.
Thank you so much. Shifting a little bit to interest rates, and maybe I'll throw this question to Johnson. What is your expectation on the local interest rate environment? Could you provide net income sensitivities versus interest rate movements for Union Bank?
Okay. Given the volatility that's happening now, who knows, right? But if we were to take a medium to long-term view, meaning towards the end of the year, we would expect anywhere between a 25 to as high as a 75 basis point cut by the US Fed and the local central bank, which kind of tracks the interest rate differential, will likely follow the same. So it could be anywhere. The first cut could happen as early as next month. The governor was quoted as saying could 50 basis points would happen, but then again, a lot of things would happen by then. So we're anywhere between 25 to 75 basis points cut. In terms of impact to the bank, we're still running we're still negatively gapped in terms of interest rates, which means that we will benefit as a whole if interest rates go down. The estimate is it's around 10 million pesos worth of profit for every basis point. So that's 25 to 75 basis point cut results to a 250 to 750 million pesos impact to the bottom line on a pre-tax basis.
Thank you. So while I have you here, there's a question on RRR. What could be the plan for the current 200 basis point RRR cut?
Okay, so the triple R cut of 2%, and by the way, there's probably more to come now. If you look at the size of the balance sheet or our deposit portfolio, a 200 basis point cut would free up around 8 billion or so of liquidity. Now, Dimi and Carlo explained earlier that we already have a program asset growth for the year. And obviously that is driven by credit view as well as the market view. So we're not about to change the asset growth size because of the excess liquidity. What is going to impact is our financing, our refinancing plan. We do have a number of long-term instruments that mature this year. We're in the process of refinancing. So obviously, the excess cash will allow us a lot of flexibility when it comes to refinancing options. The other one is, of course, that the freed up cash will lower our cost of funding in general, and that will allow us to be a lot more competitive, especially with the more interest rate sensitive corporate loan market.
Thank you so much. That is clear. There's a question on the Q&A box. I'll read it. Any guidance on this year's deposit growth? What is the near-term challenges operationally that we should look out for this year? And lastly, can you share with us how your NIMs would look like this year? Thank you.
Okay, several of them.
Yeah, so I think when you look into our earning asset growth, of course, the funding would have to follow. But I think the focus will be, of course, how fast we can grow our CASA base, and we have run programs that we expect CASA to grow faster than industry. I think that has always been the target of the bank, and historically we have proven that we can grow faster than industry in terms of the CASA. And that's because of our transaction banking business. So that's one. On the NIM, the expectation is for NIM to continuously improve. And the reason is because, first, our focus will still be on the consumer segment. And we have said that consumer will grow faster than institutional lending. And at the same time, with our aspirations to grow CASA, that will improve in the NIMs. And if rates also go down, that has a positive impact on our balance sheet because our lending size on the consumer is technically fixed, but of course the funding can go down.
And we're seeing that already.
Yes, sir. That's correct.
Especially for our subsidiaries that are reliant on time deposits. We're seeing the rates that they're getting go down, especially since the beginning of the year.
Thank you. On a related note, you mentioned accelerated growth in the retail or consumer lending. There's a question here from Rachel Cruz. Could you share any insights on the competitive landscape for consumer lending? What is Union Bank doing differently versus the other banks to grow the market share?
Well, consumer lending is really highly competitive. I think we've seen a lot of promos coming from the different banking. On our end, our focus is really strategic partnership. And Dimi mentioned a lot of strategic partnership that we have launched in 2024, and we expect that to continue in 2025.
And I think what's important in consumer is it's a long game. You have to be investing in it. And if you look at our investments in customer acquisition, customer activation, that's been going quite strong for the last, I guess, 3 years, especially since the Citi acquisition. And that takes time. You have to be patient before that really leads to more usage and essentially loans from the consumer side. So we're starting to see that as well as our average loans are also picking up. So I think that's important. It's not a short-term business. You have to invest in your customers, acquire them, give them the right, the incentive to stay with you, and then that will result eventually in larger usage and again hopefully loan balances as well. So we're reaping the benefit of the growth that started in 2022, 23. We're starting to see that here in 25 as well. So I think that's an important part. It's not a new strategy. It's a strategy that we've had, and we've been able to grow the business, and now we're seeing that in terms of income, and which that is critical for us. And by the way, we also have the ecosystem that Carlo mentioned. That's important for us, as well as the cross-selling, which will really now become accelerated as we've completed the integration. So that will be several areas that will allow us to grow, we believe, faster than industry.
Great. Shifting gears a little bit, there's a question on investments portfolio. Is Union Bank looking to grow the investments portfolio rather than its loan book?
Is it the securities? If it's the securities portfolio, no, we're not necessarily going to grow it aggressively. We have certain maturities. We tend to replace them opportunistically. The yield curve has steepened, so that provides some interesting opportunities to generate a carry based on the shape of the curve now. But it's not, we are around 30% of our assets is in the securities portfolio, and that proportion is sufficient for now.
Thank you. The next question is on capital adequacy ratios. What is the target CAR for Union Bank for 2025? Are there any plans to issue new shares?
Definitely, we don't have plans to issue new shares. I think we have presented that we have very strong capital ratios starting this year and coming from last year, and we raised capital already last year. The CET1 ratio will most likely be at around 14%, but of course, this is just a guide, can go anywhere up or down that level. We also have to check where the industry is. Of course, even if we have an internal target, we also have to see where the competition is and compare our levels of capital against our peers.
Thank you. There's one more open question in the Q&A box. I'll read it as among the consumer loan book portfolio, is there any particular segment that Union Bank is going to focus on growing?
Well, definitely the credit cards.
Mhm.
That has been the case. I think on the secondary side, the personal loans has also been quite successful. And last year we also started pushing again mortgages. We instituted what we feel is a better risk-based approach to pricing, which has also started to show good results. So I think that will also be another area. And I guess if you look outside of the parent, City Savings continues to grow. The teachers' loan market continues to be a good one for us. And City Savings will continue to grow that, as well as other non-debt and type of salary loans as well.
Thank you for that. I do not see any open questions.
I think, was there one from Aris from Metrobank? Or was this sent in? Maybe he sent this in. He has a couple of questions here. What is UBP's provisioning and write-off policy,
Yes.
Especially for the consumer portfolio? So I think this is pretty straightforward. I don't have the exact days, but I think
180.
180 days is fully written off.
Yes.
So the provisioning begins after 90 days. No, begins after 30 days and then escalates, but it's fully written off on the 180th day. And so, in fact, if you look at the credit cards as well as the personal loans, the covers are well over 100%. So so these ones are so he also had a follow-up question on does the bank have specific targets, or maybe that was mentioned earlier. And really it depends on the type of loans or portfolio, right? So if it's, as we mentioned, personal loans, credit cards, and the goal is to be over 100%. It's different if it's mortgages, where you have the security of the land, of the property as well. Our target, we don't have a target as a whole, because it really depends on how the portfolio mix comes along. But on the consumer side, we tend to be, I don't know what our exact number is now, but we're somewhere in the 60s, which is probably in line with the rest of the industry on an aggregate basis. But again, it depends, because we have a mix of mortgages, salary loans, as well as the credit cards as well. So I don't think we don't have targets on a portfolio basis. We have targets per segment or per product.
Got it. Thank you so much. There's one more question in the Q&A box from Maria De Vera. Can you share again your comparative figures for cost-to-income ratio? How do you see your cost-to-income ratio to look like moving forward?
Can we go to that slide or no?
Okay.
Oh, it's okay.
So we ended 2024 at 56%, and Dimi mentioned that if you take away the one-offs arising from the integration, it should have been better. They think 53, 54%. Now, the going concern target of the bank is a 50% cost-to-income ratio. So, of course, the expectation is that it should continue to trend downwards, coming from where we were in 2024.
There.
Yeah. We ended the year, fourth quarter was about 54%.
Yes,
So
for Q alone.
For 4Q alone was about 54. So that's I think a good benchmark. But definitely, I mean, if you look at that slide, oh, sorry, thank you for bringing it to this slide. It has been trending downwards on a quarter-on-quarter basis. So again, the big drop was because of the TSA, but we still had some recurring integration costs and builds that we needed. That was probably completed by the third and fourth quarter of last year. So of course, we still have some costs to continue to grow the business, so that won't go down. But we do expect the technology cost to at least little by little stabilize, and as the income catches up, which is for me the key here, we really do expect that the 50% target is achievable within the next couple of years.
Thank you so much. I do not see any more open questions. Just to remind everybody, if you have a question, you can type it in the Q&A box or also click on the raise hand button so we can call on you. One last call. So with that, maybe we can wrap up the Q&A portion for today's session. Thank you very much, Demi, Johnson, Dominic, and Carlo. For the benefit of those who missed the session or would like to rewatch the event, a recording of this briefing will be uploaded on our website. So on behalf of Demi, Dominic, Johnson, Carlo, and the entire presentation development team, we would like to thank you all for joining. See you all again on the first quarter briefing on May 13. And for those joining us for Aboitiz Power, see you this afternoon. Thank you.
Thank you, Jackie. Thank you to the team that helped us put the presentation together. Thank you.